Now let's talk about transportation and travel expenses. There's a difference between these two. Transportation expenses are essentially expenses, they don't involve an overnight stay. So it's kind of day-to-day transportation to and from different job sites and that sort of thing. Travel expenses generally involve an overnight. Okay, so some sort of like you got to go to a conference and you're flying out to the conference, that would encompass travel expenses. And there are some distinctions between how we calculate the deductions. These are all, you know, as long as it's business related, it's an ordinary and necessary business expense. So transportation expenses, there's a deduction for business transportation expenses from one place of work to another place of work, as long as the expense is not for commuting. There is an infographic here, which we'll look at, which is really helpful. It's in your book. It should be accurate, unlike the bonus depreciation. And I'll go through it, the different circumstances under which transportation expenses would be deductible or would not be deductible. One big distinction is between business transportation and commuting. So whenever you go from your home to your place of work, that is considered to be commuting. That is never deductible under any circumstances. So me, I live in Ames, I drive, well, this isn't a great example because I'm not self-employed, but let's just say I was self-employed and I had an office here in Ankeny. I live in Ames, I drive from Ames to my office in Ankeny, that is commuting. If I had an office in Cedar Rapids and I was driving from Ames, 2 hours away, doesn't matter, it's commuting, it's not deductible. You know, if I took an airplane to my place of work, that's commuting, right? That's not, if I were, you know, Elon Musk and took a helicopter plate different, you know, to my main place of work, it's commuting, it's not deductible. Doesn't matter that it's really expensive, it's still not going to be, if it's commuting, it's not deductible. Okay, in order to determine whether a cost or whether it's transportation, deductible transportation, or it's commuting, you got to determine what the taxpayer's tax home is. So that would be their regular place of business. That's their tax home, their regular place of business, regardless of where the person actually lives. And that's important because you might have multiple places where you do business, right? You might have multiple offices. You might have an office space in your home and have a regular office somewhere else. Well, wherever it is that you regularly do business, your principal place of business would be considered your tax home, okay? So any expenses going from your home to that location would not be deductible. Let me get past this. This is an example with depreciation. This is the, we'll come back to this. That's the depreciation form. You'll become familiar with that in the tax return problem. Let me get back to, here's this infographic. Okay. And I wonder if I can do that. No, I want to make this a little bit smaller so you can see it on my screen. So this is showing different commuting options or different transportation options and whether or not they're deductible or not. Here's your home. Whoops. Okay. So here's the home on the left side. Going from your home to your regular or your main job, your main location of work, is never going to be deductible. So driving from just to your main job. Driving from your home to a second job also is never going to be deductible. It's still considered to be, and this is a second separate job. It's still considered to be commuting. Driving from your home to a temporary work location. So let's say, again, I've got, I'm a CPA, I live in Ames, I have an office in Ankeny, but I have a client in Des Moines. That client's office, if I go there, would be considered a temporary work location for me. I'm going there for work, temporary work though, I don't spend all my time there. So if I have a regular or main job at another location, which I do, if I go from my home to that temporary work location, it is deductible. Okay? So, however, if I don't have a separate place of work, say I just work from my home, then going to that temporary work location would be considered commuting. Really, I'm just going to I'm going to my work location. So that's only if I have a regular or main job at another location. If I go from my regular or main job to the temporary work location, so I go from my office in Ankeny to the client's office in Des Moines, that is always going to be deductible. Going from my regular job to my second job is deductible. Now, keep in mind, this is only for individuals who are self-employed. So people who, like if you've got two W-2 jobs, going between those two jobs is not, there's no tax deduction for that, right? But we're assuming that these are both self-employment jobs. That is deductible. Also, going from a temporary work location to my second job is also always deductible. Okay. So, and here's some more details about the definition. So home, place where you reside. Transportation expenses between your home and your main or regular place of work are personal commuting expenses. Regular or main job, that's your principal place of business. If you have more than one job, you must determine which one is your regular or main job. Consider the time you spend at each, the activity you have at each, and the income that you earn at each. Temporary work location, this is a place where your work assignment is realistically expected to last and does in fact last 1 year or less. So that's a long time, 1 year, but that could be considered a temporary work location. Unless you have a regular place of business, you can only deduct your transportation expenses to a temporary work location outside your metropolitan area. I had a client years ago who he worked in Minot, North Dakota. He was like on the oil, he worked at, he was, whatever they do, oil fields up there. And he was self-employed. And because his assignment was expected to last 6 months, and it did last 6 months, that was considered a temporary work location. So his expenses of going from Iowa up to North Dakota were deductible for him because that was a temporary work location. Second job, if you regularly work at 2 or more places in one day, whether or not for the same employer, you can deduct your transportation expenses of getting from one workplace to another. And so one example, if it's the same employer, again, it's not, they use the word employer, it doesn't really, this is only for people, for self-employed individuals. So you really wouldn't have an employer and have this apply. It used to be, before 2017, you could deduct those expenses as an employee on your, as an itemized deduction. You can't anymore. So this really would be from one Schedule C business to another Schedule C business. If you do not go directly from your first job to your second job, you can only deduct the transportation expenses of going directly from your first job to your second job. You cannot deduct your transportation expenses between your home and a second job on a day off from your main job. So if you are gonna go from your regular job to your second job, don't stop at home first. Because that's not deductible and that's not deductible. But this is deductible, right? Because that would be considered commuting. Now this is too small. Hold on a second. So here's some other examples. Local transportation costs are deductible in following situations. So getting from one workplace to another in the course of conducting a business or profession when traveling within the city or general area of the taxpayer's home. So you're going from your office to a client's office, that sort of thing. Visiting clients or customers, that would be an example. Going to a business meeting away from your regular workplace would be considered deductible transportation expenses. Getting from home to a temporary workplace when the taxpayer has one or more regular places of work. They can either be inside or outside of the taxpayer's tax home area. So here we've got Catalina, self-employed computer analyst in downtown Atlanta. She maintains an office at the downtown location, but lives 30 miles out of town. Currently performing a job that will last approximately a week that's 45 miles on the other side of Atlanta. So 75 miles one-way trip from her home. Because it's a temporary work location, she can deduct the cost of her transportation from her home to the temporary location. Same facts, however, every morning Catalina goes to the office for 2 hours. In this case, only the cost of her trip from her office to the temporary work location is deductible. The cost of the trip from home to the office is commuting. She shouldn't be stopping at the office first, right? Because that's costing her a deductible expense. So if the taxpayer's principal residence is their principal place of business, the cost of transportation between the residence and either a temporary location or a client or customer is deductible. So we're talking about home office. Yeah. All right. So we know that kind of helps us to define what types of transportation, how to define what our deductible transportation is. How do we calculate it? There are 2 ways that we can calculate it. We can take actual expenses or we can take a mileage rate. Either way, we have to keep track of our records. We have to keep receipts, we have to keep log, we have to keep a driving log for either one of those situations. So the date that you made the trip, the purpose of the trip, what your odometer reading was at the beginning and the end of the trip, some sort of log. There are apps now that will do this, that you can just, with using the GPS on your phone, you can just press the button, when you start, press the button when you stop, that sort of thing. But then you do have to enter in what the purpose was of that. So those substantiation requirements, again, you don't send it in with a return, but if you ever get audited, the IRS would want to see that. It has to be contemporaneous, meaning you have to keep track of it at the time that the expense occurs. You can't just you can't wait to the end of the year and then put it together. Okay, so it has to be contemporaneous. So let's start first with the standard mileage rate, because that's where the book starts. So the IRS puts, we already talked about a mileage rate for charitable contributions and for medical expenses. We had those mileage rates. We have another mileage rate for business purposes. This one is higher. I think in 2023 it was 65.5 cents a mile. Does anybody want to look up? I don't know off the top of my head what it is in 2024. It is dependent upon inflation and what gas prices are and things like that. So does anybody want to look up 2024? It changes every year. It'll change in the middle of the year sometimes too. So
67 cents.
67 cents a mile. Okay. Pretty hefty. Used to be like when I was using it, it was a lot less. It was in the low 30s. But because gas is a lot more expensive, insurance is a lot more expensive, maintenance is a lot more expensive, all that stuff, vehicles are more expensive, that rate goes up with inflation. So you can use this standard mileage rate, and all you do is pretty simple. You just take the number of business miles that you drove and multiply it by that business mileage rate to get your deduction, okay? You can use the standard mileage rate if you own the vehicle and you use the standard mileage rate for the first year it was placed in service. So if you used it for the first year, then you can use that standard mileage rate. If you lease the auto and you use the standard mileage rate for the entire lease period, right? You cannot use the standard mileage rate if you have claimed any depreciation on that vehicle other than straight line depreciation, Section 179 or bonus depreciation. So you didn't get it, because in that 65.5 cents per mile, they have baked in the depreciation deduction, okay? Or if the taxpayer operates 5 or more cars simultaneously in business operations. So if you have a fleet of vehicles that's 5 or more, you cannot use the standard mileage rate. You have to use actual expenses. If you use the standard mileage rate, you cannot deduct any actual car expenses. So you can't, even though you need to keep track of the oil and the gas and all that stuff, you can't deduct those expenses, okay? That mileage rate encompasses depreciation and lease payments, maintenance and repairs, gasoline, oil, insurance, and vehicle registration fees. So all you do, multiply the number of business miles driven, multiply it by the standard mileage rate in order to determine what the deduction is. You do have to have certain other information, the date that the vehicle was placed in service. They also want to know what your total personal miles driven were, like the total miles, and then how much of that was business. So here we've got Marta, self-employed baker, makes wedding cakes for pastries and pastries for parties. She owns a car for going to meetings with clients and a van that she uses for delivering cakes and pastries. In this case, she can use the standard mileage rate for both the car and the van. She's got less than 5 vehicles there. You can also, in addition to the mileage rate, if you're paying interest on the vehicle, so you finance the vehicle, you can still deduct interest paid on that. Also, parking fees, tolls, and property taxes. So this up here, remember, this would be the same distinction. It says vehicle registration fees. That wouldn't be a tax. But those personal property taxes that we deduct on the Schedule A, you can also, in addition to the standard mileage rate, you can deduct those personal property taxes. So here's an example. Ed purchased a vehicle for business and personal use, 2023. Used the vehicle 60% for business, So 14,000 miles incurred ratably throughout the year. Use the standard mileage rate to calculate his vehicle expenses. He also paid $1,600 in interest and $180 in county property taxes on the car. This would be his business deduction. So 14,000 total miles times 65.5 cents, so a $9,170 deduction there. Interest, he gets 60% of it because 60% is the business portion. Property taxes, again, 60% of that. The other part of this would go on his Schedule A if he's using a Schedule A. So part of it would go on the Schedule C, part of it would go on the Schedule A. So his total deduction for vehicle expenses is $10,238. Oh, and they mentioned here, so the 72 that's remaining here, that goes on the Schedule A as an itemized deduction. So it's pretty easy. You still have to keep all of those records and everything, but it's an easy, easy thing to keep track of. The other option, so this again, mileage rate is 65.5 cents per mile times number of business miles in the year. But you don't, so like I said, no depreciation. No depreciation, no gas, no oil, no repairs. But yes, you can take interest, payments, parking, tolls, and property taxes. Okay, so you can take this on top of the mileage rate. Actual expenses are just exactly what it says, actual expenses. So you do have to keep track of everything again. So this would be things like gas, oil changes, repairs and maintenance, depreciation, subject to those limitations that we talked about for if it's a luxury vehicle. And then all the other things, interest, property taxes, insurance, and all that other stuff. So this, I should add insurance up here for a note. So you don't get to take that. That's all encompassed in that 65.5 cents. All right, so you do have to divide the expenses between business portion and personal portion. So if you use that vehicle at all for personal purposes, you got to take that out and apportion it between the business and the personal portions. Allocation based on mileage can be used. So if you keep track of that mileage and you keep track of the total, so in your log you've got personal usage as well as business usage, then you can accurately pull out and determine what the business portion of these are and what the personal portion is. Once you have taken depreciation on a vehicle, you cannot use the standard mileage rate in any future years. So if you've used the standard mileage rate in the past and you decide to switch to actual expenses, then you have to use straight line depreciation and you have to reduce the depreciable basis by 28 cents per mile. So you would reduce you would reduce this 65.5 cents by 28 cents per mile. So again, if you start out, if you've taken any depreciation, you cannot then switch to the standard mileage rate. If you start out using the standard mileage rate, but then you want to switch to depreciation, then you've got to reduce in the future the depreciation. You've got to reduce that mileage rate by 28 cents because you've already taken the depreciation on it. So we've got to pull out that depreciation from that standard mileage rate. Actual expense method usually results in a larger deduction, and usually upfront a larger deduction, because you can take, you know, that luxury vehicle limit, you can take $20,000, right? But it requires you to keep those receipts, the mileage log. These things are required anyway. Well, at least the mileage log is required in either case. And you can choose, so you can take the standard mileage rate for one vehicle and actual expenses for another vehicle. The thing about that is that usually when you're using actual expenses, the biggest deduction here is going to be the depreciation. And that depreciation is only going to last for 5 years, right? Then it's going to be fully depreciated. So if you think you're going, whereas the mileage rate, you can just keep using it. If you own that car for 20 years, you can keep using it. You keep getting that deduction. So depending upon how long you think you're going to use the car, right, that might also determine whether or not you're going to use the actual expenses or the mileage rate there. Okay. Those are transportation expenses. Do you want to take a quick break and we'll finish up with travel expenses? Okay, let's do that.